Hello, with me today I have Sam Wahab, oil and gas research analyst at Peel Hunt. Hi Sam, thanks very much for joining me today.
Pleasure, Lee. Thanks for having me.
Sam, which energy companies do you think will deliver the strongest returns over the next year? Do you have a favourite large cap play?
Yeah, I mean, it's a good question. And, looking at the FTSE 100, the two bellwethers of the indice is BP and Shell. And so picking between the two, my view is Shell on balance. That's particularly given the reasons that we've discussed in terms of commodity pricing, where we see it getting weaker into 25. If you look at the free cash flow of Shell going into this year, well, this year alone is around $32 billion. And then if you look at their capital allocation, they've got a fairly attractive dividend yield, but they're also entering into share buybacks. As you go into a weaker commodity price environment, it's how you sustain that. I think they've got a resilient enough balance sheet, given that they want to continue those buybacks, pay that yield, but also invest in some of the more attractive regions around the world. And dare I say it, invest in some of these more ESG-friendly investments, whether that be green hydrogen, which I think they're getting stronger in as well. BP, on the other hand, I don't think they have the same balance sheet strength to continue with potential buybacks. Obviously, the yield will remain intact. But I think in terms of if you want the more resilience, it would have to be Shell for me.
And what about small caps? Any that investors should keep an eye on in 2025?
Yeah, well, where do you start? Because I think, the sector has been depressed for quite a few years now, despite, returning quite healthy sums to shareholders, entering into buybacks, but then what part of the market and the London Stock Exchange is not entering into buybacks at this stage? We do have a few, and I think they're for very strong reasons. A couple in the North Sea, I'd highlight Serica Energy and Ithaca Energy. Ithaca, as you know, has just returned to the market, entered into a big deal with Eni, picking up a number of assets. It isn't a liquid stock at this stage with Delek, the major shareholder there, but they will enter into much more M&A over the coming years. They're not there as a passive shareholder, and they're also throwing off a very strong yield. Serica as well. The reason I highlight the North Sea names, I think they've been beaten up to an overly punitive extent. The UK budget came in, again, I think it was pretty unwarranted, more windfall taxes and for longer, despite not being in windfall conditions. But they came in at a much better rate than the market had priced in to the stocks at that time. If you look at Serica, for example, they're throwing off a yield of nearly 20%, which people can look at a yield at that high and they think either it's unsustainable or the share price is wrong. We think it's the latter. It's clearly the share price that needs to really demonstrate what the underlying fundamentals of this business can offer. And then going forward, I think the market misses on particular North Sea names on the larger side, like Ithaca and Serica, is that they've got this tax shield through historical losses, which means that they could probably get to the end of the EPL by 2030 using that tax shield and paying much less than the 78% that I think the market is pricing in. So I think those two are desk-thumping buys at this moment. And then moving over to the US, I know we've discussed the nat gas prices there. I think diversified energy would be an excellent recipient of that. They're paying a healthy yield of around 10% as well. But they're also focusing on deleveraging the balance sheet, which has always been a bit of a bugbear for the market in terms of why not to invest in a company like that. And I think they'll continue to grow through M&A. I think having a new administration which is pro-gas production and a country which is pro-LNG export, they're in a really good space at the moment.
Okay, great. Lots to think about there, Sam. Climate change is a major influence on behaviour for many investors, and when we've seen oil companies like BP dilute their net zero targets, do you think we'll see a further backlash against ESG from the oil industry?
Possibly not. I mean, speaking with leadership teams all across the market cap scale in the industry, they're very receptive to the energy transition, and in my view, the fossil fuel majors of yesterday will be the energy transition leaders of tomorrow. So I think they take that on board. They appreciate where the world is going, not just from a sentiment point of view, but also they have been at the forefront of the energy mix as it's evolved over time, whether it's been coal or whatever going forward. So I think there'll be important players within that game. I think the key word here is pragmatism. I think that's been understood by the oil and gas sector. I think there has been a lot of activism saying that it's just like flicking a switch and we'll move over to wind power, battery, hydrogen, which is an undeveloped market currently anyway. So I think the understanding is there, but as I say, the pragmatism means that they have to row back on some of these pledges because they're untenable, really, to a certain extent. And I think the world is slowly becoming a little bit more receptive to that way of thinking, that renewables, which is a good thing, will have to coexist with fossil fuel production or a transitional fuel like gas for the time being, until we get to a situation where we can have baseload power with intermittent inputs of energy. So overall, I don't think it's a massive backlash. I just think it's a wider appreciation of how the energy transition will play out.
Okay. Sam Wahab, oil and gas research analyst at Peel Hunt, thank you very much for joining me today.
Thanks for having me.